Alright, welcome back everyone. Today we're going to be talking about entry confirmations or trade confirmation, whichever name you want to give them. Alright, so I hope everybody's doing good on a Saturday. Enjoy your weekend and just let's get started. Okay, so we have a couple of types of trade confirmations or entry confirmations. So let's go over them and then we're going to take each one and we're going to go in details with some examples. So we had the first one is trend confirmations, which is basically means that you just take trades with the trend, and then there's going to be, and then the engulfing candles like an extra confirmation you can get on this type of setups. Then we have break and retest, which is self-explanatory. You wait for the price to break certain zones, certain areas, and then retest them for you to take the trade. Then we have high time frame versus lower time frame confirmations. Again, self-explanatory, and we spoke about this before. Candle closing confirmations, which is basically just waiting for the candles to close, so that tells you where price might keep going and which direction, if it's a fake out or not. Then we have momentum, which is basically just how big candles are. And last we have Fibonacci or Fib Confirmations. Okay, let's get started. Trend confirmation. So market moves in phases, as we know. So you have a push phase and a pull phase, as we say here. So market with trend, that's going to be a push phase. Market with trace, that's going to be a pull phase. So example. So you have a bullish market. So price with trend, that's going to be a push phase, your pull phase, and your push phase again. Usually when you have a push phase and a pull phase, price will create a support or a resistance, depends on which type of trend is it. For example, we see that here in a bullish trend we created a resistance. Price should not, I repeat, price should not break below the previous low, which is here. Price should not go below it. Should retest it, yes, but should not go below it. And then for a bearish trend, which is the same principles, you have a push phase, a pull phase, or a retracement phase, whichever you want to say, and then we have a support for it. Price cannot go above this area. Okay, so push phase, you got a pull phase, and these are your phases of the market. These are the areas where you want price, where you want to buy the price. So basically, if you're in a bullish market, you want to buy here, so you can keep going. So that's going to be trend following or trend confirmation. You want to do the same here. So you don't want to buy on a push phase, because eventually price has to go back. So if you buy here, there's a higher probability that you will fail. But when you buy here, when price goes against the trend just to get momentum and keep going, that's where you should enter. So like it says here, entry points, which is these two areas, either here on a bearish market or here in a bullish market. Okay, then we have engulfing candle, which is the other confirmation that you would be looking for. For example, this is what an engulfing candle is. So let's say we're looking for buys. Okay, there's a candle that formed, a bearish candle that formed at support, resistance, doesn't matter. I'm just speaking example for now. So we have a bearish candle that formed, and then a big bullish candle will form after it. So this is what we say engulfing candle. So a small candle followed by a bigger candle. The bigger candle will indicate that the next candle should be another bullish candle, so price can keep moving in that direction. I repeat, it should. Okay, let's do an example. So we have a bullish candle, and then a bullish candle. So now you have three bullish candles that have been overtaken or engulfed by a bearish candle. So what that means is the next candle should be another bearish. Why? Because the momentum has been shifted, or the trend has been shifted. So the next candle, then we can see you created a support. So that means at this area we want to sell. So price is coming down, price has retraced, and then price is going down again with a big momentum. That's how you know you got to trade. For example, you have this. So price is coming down. You have a small bearish candle, then followed by a big bullish candle. And you see what the next candle was? It was another bullish candle. So that's what an engulfing candle means. So that's one type of confirmation. You could use it at support, at resistance. You could use it most of the time. But you try it, you backtest these strategies and see which one works for you best. Then we have higher time frame versus lower time frame confirmations. So higher time frames dedicate market trend. So what that means is the daily candle dedicates how the 4 hour should be. So if the daily is bullish, that means the 4 hour, the 1 hour, the 30-minute and the 15-minute time frame should be bullish as well. Yes, there is going to be retracements, it's normal, but they should close in bullish trends. They should not be closed in bearish. So that's what the high time frame dedicates market trend means. High time frame is a stronger confirmations than lower time frame. So for example, let's say if my 4 hour candle is bullish but my 15-minute candle is bearish, that doesn't mean the trend is bearish because my 4 hour is still bullish. So that's basically what that means. Higher time frames are stronger than lower time frames. Always look at the big picture. If you can see on the big picture, on the big time frames, which is daily, 4 hour and the 1 hour, that the candles are green or bullish, then most likely the other time frames should follow. So we're gonna do an example. So 1 hour candle is equal to 4 hour candles. So 1 hour is equal to 4 15-minute candles. So let's do an example. You always need to cut the noise, which is very important. So let's talk about this first. So what this means, so if you have a 1 hour candle equals to 15 minutes, if 1 or 2 of the 15-minute candles are bearish, then the other 2 are bullish. It does not mean that the 1H is going to be bearish or bullish. It could be neither. It could be a doji, or it could be bullish if we have big bullish momentums, or it could be bearish if you have a bigger bearish momentum. So always look at the higher time frames. These are the time frames that will tell you what should be happening, especially if you can look at the previous candles. So cut the noise. This is a big part of trading and understanding markets. So for example, what I mean by cut the noise, you don't want to be looking at small time frames because that's going to be too much noise for you to follow price action to understand. So let's do an example. So this is a 15-minute area that we're gonna look at this area a couple of times. Okay, you see this how it look, this area, this is what it looks like on a 15-minute. You see how many candles? There's a lot of candles. Okay, so this for traders, or at least for me, a few other people, this is noise. This is something we don't want to look at. Why? Because there's not any information that I could use. So there is less candles on the higher time frame, so there is less noise, but to try and filter. So I don't want to look at this and be looking, okay, there's too many candles, there's resistance, 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 resistance. I don't want to be looking at this. I don't want to be looking at higher time frames, just having one resistance or support level. So when you look at the same area and this on a 1 hour, you can see 1, 2, 3, 4, 5, 6, all these 6 candles, and I can already say that or I have a support right here, resistance, resistance right there. I can see that. But here I have 1, 2, 3. Which one will I be trading? Which one will I be using? There's going to be a lot of mess, so that's something I don't want to be looking at. Just one on the higher time frames, that should be more than enough, and that will help you a lot. Okay, so let's keep going. Then it says clean, as we just mentioned. Okay, then if you go to, just 1 second. Okay, then here we say there is less candles on the higher time frame, so there is less noise to try and filter. We spoke about this. Okay, so this is my example that I was looking for, which is, we're going to be talking about this now. So we're going to be talking about this. So we said one candle is equal to 4 15-minute candles, right? So that's one bullish candle which created a support, a resistance, I mean, right there. Then if you break it down to 15 minutes into 4 15-minute candles, this is what it would look like. So we got a bearish which created the bottom wick, which is that. Let me switch the colors. Which created this. Okay. Then we have the other bullish candles that are gonna create the the 1 minute candle. These two created this. So we can see that the 1 hour closed where below a resistance, right? But the 15-minute closed above. So a lot of people would take buys here. So I would say, oh, the 15-minute closed above, so I'm gonna take buys. But that's not true. Why? Because the 1 hour didn't close yet, and the 1 hour is stronger. Yet again, the 30-minute didn't close because this was your first 30. These two were your first 30, and now you still need one more candle to close to give you another 30-minute candle. In this instance, that 30-minute candle will create the top part of the candle, and then it will close below, which will happen here. This is something you don't want to be in. If you have to wait for the higher time frames, always wait for the 30-minute, for the 1 hour, or the 30-minute to close for you to decide if you're gonna be taking a buy or a sell. Because, like I said, these time frames will decide what are the confirmations you have. The higher time frame, the better the trade will be. Okay, so let's go and talk about break and resistances now. So break and resistance is self-explanatory. You will want to price to break an area, retest it, and then take the trade from there. You could use this alone as a confirmation, or you could use it with any other confirmations that we'll be talking about today. Okay. Markets usually visit the same areas it's been before, which is true. So if price creates a resistance and then it fails to break that resistance, it will go back and test it again to see if it can break it. In these areas there would be rejections, which is, like we said, price will create an area, price will go test it and see if it's able to break it or not, which we call rejections. And then these rejections there is a possibility of a fake out. Price could try and break them and fail. Price could break them and fail to stay up broken from these areas and eventually come back within. So let's do this. So this is an area that we spoke about. So you can see rejections, rejections, rejections. So you can see this is the area we will be looking at. You see the first rejections, a rejection again, and a rejection again. So price rejected this area, so we could not break it. Okay, so this we can see there's a wicks which are fake outs eventually. So that's something you don't want to get in. How to identify a fake out? So we'll talk about that later. So if we look at this, you can see price came, rejected again here, and rejected again. It did break eventually, but the break didn't stay. Why? Because price failed to stay above the level. If price fails to stay above the level and breaks down again, that's what we call a fake out. Okay. So how would you identify this? You would need for candles to close. If the candle hasn't closed, you cannot know if it's a fake out or if it's an actual break. If candles come back within the area, that's a fake out. You cannot take the trade you were looking for. In this case, it would be buys. You cannot take the buys, and you just have to wait for an opportunity for you to take a trade. So that's how you identify a fake out. You would need candles to close above the area, above resistance or below support, whichever one you'll be looking at, or above a trend line, whichever type of trading you use. So that's how we identify a fake out. Okay, so let me erase this. Okay, let's keep moving. then we can see you would need price to validate these breaks by retesting them. So if price does not retest this area to tell you, okay, this area is strong, and we break, and our break is validated by us retesting it and not saying and not going below, then you know that this break is good. Okay, but by giving the confirmation that it's not, but that it's a break and not a fake out, which we just saw what a fake out is. So an example for break is this. So we can see price came above, you had this bearish candle that closed above the area, which you can see retest after the break of the support of the resistance, excuse me, on this one of the resistance. Candle confirmation, this candle gave us the confirmation that yes, the break is valid because I did not go below. If this and these two candles did not come down below, that means that the break is good. Now all you need to do is take the trade, take a buy, and just ride the trend. That's it. So you would need a break, a retest, that's your retest, and then this is your confirmation candle that tells you, hey, I'm not going nowhere, I'm still bullish, we're gonna keep moving up, and that's the trade you'll be taking. It's very easy, it's a very easy concept to understand and follow. So I hope you can follow, I hope you're following with me right now. So I'll repeat it again. Price was bearish for a long time, and then price created this level. If we needed to go bullish, we had to break this level, which price just did here. Came above, broke it. We had a retest with this candle, and then we had another retest with this candle, because this is a wick. So it retested and rejected. We had a wick, and then we had a bearish candle, so that tells us yes, this is the confirmation. And then this candle again is another confirmation, tells us I'm not closing below, I'm closing above, because we want to keep going above. So, and then from there you can take a trade anywhere you want, it's up to you, and you just follow the trend. The trend is up, you take buys, that's it. Alright, let's go to the next one. Candle closing confirmations, which I spoke about a bit earlier, but now we're going to talk about it in detail and see why they're important. Candle closing tells you where the next candle could possibly go. So if we get a bullish candle close, a strong bullish candle close, that means the next candle could possibly be a bullish candle. So that's something we should know. Okay, like we said, higher time frames are stronger than lower time frames. So a higher time frame closure, a candle closure on a higher time frame is way stronger than a closure on a lower time frame. For example, a 5-minute close is not gonna mean that the candle is gonna go bearish if the 5-minute close is bearish. If the 30-minute close is bearish, then yes, there's a possibility that the 1 hour will close bearish. So the lower time frame, the weaker it is. Look for confirmations on the 30-minute and the 1 hour, because these are your entry confirmations, entry time frames, or whichever time frame you want to use. It's up to you. Don't quote me, don't judge me on that. I'm just giving information. You can use whichever time frame you want, as long as it's a higher time frame and a strong time frame for confirmations. Okay, so let's do an example. So we already said that the 1 hour is composed of 4 15-minute, which is exactly this example, right? And we said that this is, okay, let me do this. We already said that these two are 1 30-minute candle, right? So that's what we said about these. So that's the first 15, that's the second 15. Now if we break this on a 30-minute chart, this is what it would look like. So you have the 1 hour, which created the resistance. Then you have the first 30-minute. So this is equal to this. Then you would have the second 30-minute, which is this, is equal to this. Because these two, when they go on the higher time frame, would look like this. So you have the first 15, which pushed up. Then you have the other 15 which came back down, which made the 30-minute close bullish, yet below this area. So that's what happened. So that's why the 30 minutes are better than the 15 minutes. Because one 15-minute does not mean that the whole chart that we should be taking buys. Because the 15-minute has another candle on its higher time frame, which is a 30-minute, and tells it, hey, the candle didn't close yet. We still have another 15-minute that we need to close and then see what could happen. That's why taking 15-minute entries or trades are very risky. I'll show you an example. So this example is on a 15-minute chart, as you can see here. 15 minutes. So we created this level at 15-minute breaks, right? So I would take it to a sell because I got a 15-minute close. Then the other 15-minute came back above, and that's at my 30-minute close. That's my 30-minute time frame. So basically on my 30-minute the candle would look like this, would look something like this, with a body somewhere here with a big wick at the bottom. That's how my 30-minute would look like. So that's why, just an example, so that you don't take trades on the 15, you would take them on the 30-minute, which is better confirmations for you to get good setups, good trades, and become profitable over time. Okay, let's go another example. So this is a 30-minute. Alright, so let's see what we can do. So let's switch the colors. Let me go with red, it will be more visible. So we can see that we had the resistance. That's my 30-minute. I waited for the 30-minute to close this time. Because look, 15 broke, the other 15 came back. Or is it the other way around? I'm not sure, but we can see that there's a big wick. This wick could have ended up closing right here. Could have had this body and then big wick at the top. But if that happened, that would have been disastrous for me, because that would have been another losing trade. That's why I decided to wait for the close. I got my close above, which is a 30-minute. Then all I had to do is just execute on the next 30-minute. The 30-minute candle formed, went down, so I let it do its thing. When it came back up, I took the trade. And bam, a winning trade. That easy, that simple, it's not complicated. Wait for candles to close. Candle closure is very, very important and is underrated also. If a candle closes in a new direction, that tells you there's a probability. Okay, let's look at this example. I didn't even plan for this, but since we're at it, we can see. This is a perfect example of engulfing candles. Okay, and I closing candles at the same time. So price came up, created this level, rejected it. That's a rejection, that's a rejection. Okay, this candle engulfed the bullish candle. So you can see that's a big candle, but the bearish candle is even bigger. So basically it ate the other candle. In simpler terms, we said with an engulfing candle we can expect that the next candle would move into the direction of that candle, which we can see here. Big bearish candle followed by another bearish candle. That could be another trade right there. Target, entry, target, or wherever you you would want it. It's up to you. Just an example. And that's another trade, another winning trade. Just an example of how you could use different types of confirmations or setups or trades to take a trade and you could win it. Closing candle, which we just spoke about. Engulfing candles again. So I got the close, I got this candle which engulfed this candle, but I waited for it to close and then the trade would have been there. So let's talk about momentum. What is momentum? So momentum is basically, it's not a what or a who, it's just a thing that happens in the market. So for momentum to come, it comes in a specific time frame basically. So what I mean by that, so momentum comes during sessions. So we have Asian session, London session, and New York session, right? And this session we have other sessions. So we have pre-Asian, Asian open, Asian close, pre-London, London open, London close, pre-New York, New York open, and New York close. So during these type of sessions, there's momentums. Pre-New York, there's a bit. New York open, there's a lot. New York close, there's a lot. Why? Because New York open, that's basically when the time that orders come in from the markets, from the big guys, from the institutions and these guys, or whatever you want to call them. I don't care. That's where the momentum comes in. When these guys start putting, okay, I want to buy this level, I want to sell this level, I want to buy here, sell there. That's where momentum starts generating, momentum flow. These are the times where you can see candles are on their biggest. Instead of being small candles, there will be big candles. When it comes to a specific time of the market, which we just spoke about, okay. With momentum coming to the markets, candles become bigger, and the probability of winning a trade is higher, which we just said. So, for example, we have the Asian session. Asian session starts from 8 to 10. At these times, that's where the momentum is going to be there. Then we have London session from 3 to 5. That's where the momentum is going to be. That's where the big candle is going to be, which are you trading candles. And then the London, or pre-London, pre-New York, from 5:30 to 8. That's where another good amount of momentum comes. So it happens after London open and keeps going to 8 a.m., which is before the New York open. So these are the times where you see big candles. So let's see an example. What happened? Okay, there we go. This is a 9 a.m. candle compared to a 12 p.m. candle. So you see, that's a 7 and that's an 8 and this is a 9. So these candles quite big, but the 9 compared to the other candles is way bigger. So at that time, the New York Stock Exchange is about to open. That's why there's big candles, because the stocks market is opening soon and people are gonna start trading and money's gonna start moving. So that's why we have this big candle. And then at 12 probably which is a lunch break, so there's no momentum. Momentum dies and that's it. So always look at specific times where you want to trade that there's momentum, so it makes it easier for you to take positions and win these positions. Fibonacci confirmations, or Fib confirmations. It's not my favorite, but it's there. It's a confirmation that you guys should know in case some of you like it. So let's get it. So Fibonacci confirmations, it's a tool basically that you use to determine till what point price would retrace in a trend, so you could take the trade there. So you can only use it in a trending market, which is true. If the market is not trending, it's not producing. For example, if it's a bullish trend, if the market is not producing, higher lows, higher highs, higher lows, higher highs, you cannot use it. If it's a bear trend, if market is not producing, lower lows, lower highs, lower lows, lower highs, you cannot use it either. Why? Because the market would be in that case consolidating, going sideways, which is something you don't want. So for example, let me bring my magic pen. Okay, you can see that price is creating higher highs, higher lows, higher highs, higher lows, potentially a higher high, a higher low, and another higher high, and a higher low again. So we know that price is doing this, right? So we know that we're going up. Okay, so we identified that it has to be a trending market, which is good. So Fibonacci is this tool. Is this tool, the one in the white and yellow? That's a Fibonacci. Is basically you take it in a position, you take from the bottom all the way to the top, and that would tell you until what potential area price would retrace. So like it says here, it tells you to what possible price area that price could retrace, so you could take a trade to continue the trade, the trend, or the trade. If you're in a trade, or you wanna, let's say you bought here and then you sold here and you still keep going with the trend, that's what it tells you. So okay, so Fibonacci is basically, you have these two areas, the 0.5 and the 0.618. This is what people call golden zone, or traders. Like I said, I don't use it, I'm not a big fan, but it works. People use it, they implemented it, you can implement it too, and you could possibly win and benefit from it. So basically you take the fib, you put it at the bottom, you drag it all the way to the top, and then these lines will pop out. So this will be your golden area, this box. When price comes into this area, there is possible to take trades to continue the move up. Okay, but you would need confirmation. So if price comes here, you don't just take a buy. You would tell the fib, all these there to tell you that yes, we're gonna continue the move. But now what you need to do is find other confirmations from the ones we spoke about earlier. So that's what you need to do. Golden zones, like I said, if in a bull trend, you would use the tool from the drag from the lowest to the bottoms. Okay, so let's go back for a second and not worry about that just yet. So let me erase all of this and let's talk about the fib tool. Let's switch colors. Let's do green. Okay, so we said that this is the area we want to look at, because this is the area the price potentially comes at and will keep going to its direction, which is in this case it's a bullish trend. Okay, so we know we drag from here all the way here, which gave us this. So what you would need to do now is wait for price to come in this area. Now you're gonna wait. Why are you gonna wait? Because you're not gonna just take a buy and take the trade. Price could fall here and it's normal. Price could go all the way down and it's normal. You would wait because that's what we do. You would wait, get confirmations and then confluences that tells you bullish trend, golden zone, entry confirmations, take the trade confidently, and it should be a winning trade. That's what you need to do. Confluence with confirmations, all you need to do. Okay, next. So we said if it's in a bullish trend, you drag from bottom to the top, it gives you this. If it's in a bearish trend, you just do the opposite. So you drag from here to the bottom, and that will give you the zone. The zone should be somewhere here on top that tells you, hey, price is gonna go up and then it's gonna keep going down. So that's what this means. Fib levels are the commonly targeted, which is the 0.5, which like I said, 0.618, which is called the golden zone. And that's pretty much it for entry confirmations. Like I said, it's just basic price action, some other things that you could use to get the confirmations or the confluence for you to take the trade. So yeah, let me know in the comments if this was helpful. If you guys want to see more of this type of stuff, I'll be glad to do so. And if you have any questions, do the same. Either send me a DM on my Instagram, which is posted on my YouTube channel, or you could just drop a DM and I'll try and get back to you as soon as possible. And with that being said, thank you very much and I hope you guys have a great weekend.